And good evening, everyone. Welcome to the first installment of Ask the Experts, put together by the Houghton College Office of Advancement. And our topic for this inaugural event is called Tax Advantage Giving in 2020. We're so glad that all of you could join us. We don't want to have to mute you because we want this to be a really informal time of conversation and dialogue. And if you have questions along the way, please don't hesitate to ask them. And, there's a part of me that would love to go around and introduce every person. I see a lot of familiar faces and names as I look around the screen. We're thrilled to have you with us. For those of you who may not know me, my name is Carl Sisson, and I'm privileged to serve as the Vice President for Advancement and External Engagement. And alongside of me, I'm going to introduce one of my colleagues, Dan Noyes, who serves as a Regional Director of Development. And Dan is really good. He's gotten really good at these events in this season, these virtual events. He's been running our Best Talks series, really focused on our students this semester. As we haven't obviously been able to welcome guests and alumni back to campus. And I'm going to let Dan introduce our first guest, our first expert for the night. So Dan.
Yeah, thanks for joining us this evening, whether you're live with us now or you're watching this down the road. And hopefully you'll find some information tonight that can be helpful for you as you look to make some charitable gifts at this time in the wisest way possible. I have the honor of introducing Dick Hallberg. Dick is a certified financial planning professional. He's a member of the Houghton College class of 71, a proud member, I'm sure. That's a class I have a lot of affinity for. But he also holds the title of Emeritus Professor of Business at Houghton. So when Dick graduated in 71, he went on to get his MBA at the University of Akron, and then had a 40-year career of teaching students at Houghton. And one of the highlights is Dick helped create a class in 2001 for upper level students in the business department, teaching them how to wisely invest, how to research and evaluate investment opportunities. And that class has grown over the years to the point where they were investing around $300,000 of actual money from Houghton College's endowment, and actually at a pretty regular basis outperforming our own investment group for the college. And those students made the decisions about what they were investing in with the advice and guidance of Dick Hallberg, who's with us tonight. So that's just one of his qualifications in terms of coming in here and talking to us. But I think probably he is known most for his integrity. He's known for his careful communication and making sure that everyone he works with, he understands what their interests are and wants to help them reach their goals. And we're just really grateful to have him here tonight. And Dick, just briefly tell us about what keeps you in this field, even in your retirement, and what aspects of financial planning you find the most fulfilling.
Well, thanks, Dan. It's nice to be here. As you indicated, I continue to do financial planning for clients, even in my retirement. And I do it because it's frankly just a lot of fun. There are certain, I'm sure all of you have done aspects of your work that just don't feel like work. And that's the way financial planning is for me. And, I've navigated the pathway from being scared of what was ahead and wondering, am I going to have enough money to do this? And I enjoy helping other people navigate that as well. And really, for the last 20 years, the majority of the work that I have done has been in retirement planning, helping people who were 55 to 60 to 65 as they got ready for retirement, wanting to know, will I actually be able to retire? And then once you retire, the question is, am I going to have enough money for as long as I'm able to live? And you know, as long as the Lord gifts me with more years on earth. And then how to steward that money. And I take that very seriously. When I use the word stewardship, I don't mean just giving. It's how do you manage all the wealth that God entrusts to you. You know, I'm on that journey, and I enjoy engaging other people in that and topics related to that.
All right, fantastic. I am going to introduce a former student of Professor Hallberg's. We were laughing before everyone joined us. Jonathan Heller, who graduated from Houghton College in 1999, said, "I'm not sure I'm going to be able to call him by his first name." and Dick said that you can now. We are colleagues. So Jonathan has been serving as a financial advisor since he graduated from Houghton in '99. He currently serves as the Senior Vice President and Senior Portfolio Manager for Brook Hills Investment Group, which is part of RBC Wealth Management in Lancaster, PA. And I see the Bagleys on the screen, even though I don't actually see their face. If my memory serves me correctly, on one of my earliest trips to Lancaster, the Bagleys, I think, said, "Hey, here's an article about a Houghton alum here in Lancaster. You should check him out." And I think that's when I first reached out to Jonathan, and we were able to connect. So Jonathan is exceptional at helping clients meet their financial goals. His areas of focus are wealth management, client portfolio construction, and individual portfolio management, as well as retirement planning. He holds his life insurance licenses and is a certified financial planner. His analytical skills and attention to detail provide his clients with confidence, putting their best interests first. He was a business administration major, and he earned his accredited wealth manager designation through Michigan State University. He serves on the Lancaster YMCA Foundation Investment Committee, and he lives in Lebanon, PA with his wife and daughter. They enjoy supporting Cornwell Elementary and various local conservation organizations. He truly enjoys birding. He's very passionate about that, and hiking locally, as well as when traveling on family trips to locations like Africa, Thailand, and Iceland. So Jonathan, feel free to share anything else you want with us, and why are you passionate about financial and retirement planning?
Well, thank you, Carl, for that introduction. It's a pleasure to be here, especially with my very favorite Houghton professor. So yeah, I've been doing this for quite some time, and the thing that I really enjoy about the work that I do with financial planning, I was just thinking in preparation for this call, it's sort of like a puzzle. You know, growing up, I really enjoyed doing puzzles, and when you're meeting with clients, you know, it's a process of discovery. You know, just trying to talk to them, listen to them. What are they worried about? What are their goals? What are they, you know, what are they trying to achieve? And just gathering all that information, helping to prioritize those issues for them, and then working to come up with the right solutions, the right investment solutions, the right estate planning solutions, and you know, helping people to, you know, in the case of people being here tonight, if they're, you know, one of their passions is giving and charitable giving, help them to figure out how to do that in a way that, you know, really provides the most support to the charities and the causes they want to support in a way that saves them taxes. So really just trying to come up with solutions that help people meet their goals in the most efficient way possible. When you put together a plan like that and people are happy and you feel like you've solved a problem, that's very rewarding.
Yeah, yeah. Well, as I said, I want anyone on this call to feel free to ask a question, but I'm going to get us kicked off with a question tonight. And it's one of the things, you know, we advertised that we would focus on. So this year has obviously been a once in a lifetime event, a global pandemic, significant market volatility, growing social concern and unrest. And despite all these uncertainties, we've also witnessed historic levels of generosity from individuals. In the midst of this, we successfully completed Impact, the campaign for Greater Houghton, at the end of May as well. But back in March, Congress passed the CARES Act in response to the pandemic. And so I'm curious, I'd love for either one of you to tell us what impact this is having on charitable giving, and specifically think about the difference between those who might itemize or take the standard deduction, and what are the reasons that the people might consider in their giving this year.
Go ahead, Jonathan, get us started.
Okay, well, I think there are a couple of unique features about the CARES Act. One of the big ones is that you have the ability to, if you're making cash gifts, you have the ability to give up to 100% of your adjusted gross income. Typically, that would only be 60%. So, we might have some folks that were planning on making a larger gift or bundling gifts together for multiple years. If there's a particular cause they want to support and they've had a good year, a successful year in business, a successful year in the stock market, they can give more money in the form of cash and deduct it all in 1 year. And that is a difference from previous years. They have the ability to take money out of retirement accounts if they're over the age of 59 and a half, and again, get a tax deduction for that to offset the taxable income from that. So that's the primary impact that we're seeing. You also have the ability to take a small above the line deduction as well for, I believe it's for $300. So that's what we're seeing in relation to the CARES Act here in 2020.
I'd probably just add one little thing to that, to the comment about the cash gifts. So $300 in cash gifts. That seems inconsequential in some respects when many people are giving a lot more than that. On the other hand, I'm always in favor of passing money along to charity that also legally reduces the amount of money that I owe the government. So regardless of what I might be doing out in other aspects of my giving, I certainly want to take advantage of that, as Jonathan said, that above the line deduction of $300.
Yeah, one of the things Jonathan alluded to was, the ability to deduct up to 100% of your AGI for your cash gifts. One of the important things I might add to that is it doesn't have to all be taken in this initial tax year. That can also be carried over for up to 5 years as well if you can't capitalize on all of that in the initial year. So one of the other things that became pretty well publicized because of the CARES Act was that required minimum distributions, RMDs, from IRAs, individual retirement accounts, they were waived for the tax year 2020. And I know that there's been some confusion amongst some of our alumni and donors as to the impact of that. And so I'm curious, get into the difference, of 70 and a half versus 72. What are the differences? What can you do? What can you still do? What can't you do? And does it still make sense for individuals to consider gifts from IRAs, which has become increasingly popular for our donors?
Yeah, so it still makes sense for people to give money from IRAs if they're 70 and a half or older. We have clients that do value charitable giving, so we try to convince them to give money from an IRA. It gets rid of some of that taxable income that will be taxed at some point in the future, whether they pay the taxes or their children do. So we always like to use qualified money, pre-tax IRAs as a source of giving. We do have some clients that give for tax reasons, so they give a portion of their required minimum distribution. So in some cases, we have people that would typically give in December of this year, and they may just wait until January and do a double gift next year out of their IRA. But definitely you can still give this year as long as you're 7 and a half, and that's probably preferable than just writing a check from cash.
Yeah, the other advantage to going ahead and giving it now at 70 and a half is you're going to reduce the amount of money that you're going to be forced to take a withdrawal on. So for instance, they at the end of this year, if you have an IRA that's $500,000, the government's going to tell you what percentage has to be withdrawn next year. If you make a gift this year, that'll reduce that $500,000 by a bit, and you'll actually be required to take less of a distribution in 2021. So even though you're not forced to take it, you have that small benefit. And I think that that's especially true this year, given the fact that we've had such, I'll call it, unexpected appreciation in the stock market. You know, by all measures, the stock market should have just, I mean, it did go into the tank in the spring, but it's come roaring back and is well beyond what a lot of people would have predicted for the year. So I mean, there's still time this year if you haven't made a distribution or made a charitable contribution to do that and reduce your obligation for next year.
What's a typical process? If someone has never made a gift from their IRA, what's the typical process?
Well, the key thing is the check has to go from the IRA directly to a qualified charity. It doesn't work to give money from an IRA to a donor advised fund or something like that. It has to be directly to a qualified charity. You know, we still talk to a lot of people who don't realize the significant tax benefits of making qualified charitable distributions from an IRA. So I find myself emphasizing that every time I'm talking with people who do any kind of charitable giving. A lot of times people say, well, you know, we think it has to be a larger gift. You know, we don't want to bother because it was only $1,000, only $500. So I know at RBC, if people are of the age where they have RMDs, we will actually get them a checkbook for their IRA. That checkbook can only be used for qualified charitable gifts. It has to be cashed by the charitable entity within that tax year to count as a distribution for that year. And I suppose there are probably other custodians that would also be able to get people checkbooks from their IRA. And that just makes it easier for people to use that for even smaller gifts.
Yeah, I remember you mentioning that, Jonathan, and that's something that I hadn't heard of before that I think would be really convenient for, we have quite a few Houghton donors who give through their IRA, and most of them give directly through their financial provider, and it comes right from the financial provider to Houghton. So they have to make sure that they're not writing a personal check and then reimbursing themselves from the IRA. It doesn't work that way in terms of a tax event. So that would, I think that would make it easier. But even for the folks who don't have a checkbook, I think they found it rather easy to just, you know, talk to their financial provider and say, out of my next distribution, or I want to make a check out for this much money to go to this charity. So it's been a great way for people to get a deduction for any amount. And I think the maximum is 100,000 a year.
Yeah, and I'd make one other comment too. A lot of times when you make charitable distributions from the IRA, you're going to get a tax document early the next year, a 1099-R. And typically it will show a taxable distribution, but it will not specifically itemize the qualified distributions that you've made. That's up to the tax preparer, the tax filer's responsibility to do that. So we do tell people to keep track of the donations you've made, or have your advisor keep track of that and provide that. Make sure your CPA is involved in that process so that that's not missed and you're not inadvertently paying tax on something you should be getting a tax break on.
Well, one of the other things that probably should be noted at this point, since we're talking about IRAs, and sometimes people think, okay, I've got an IRA because I've got this retirement account, but often the money is in a 401k or a 403b because that's the way you were setting aside money for retirement while you were working. You cannot make a qualified charitable distribution from a 401k or a 403b. Instead, what you need to do is take a portion of either all or a portion of the money out of the 403b or 401k, roll it over into an IRA, and then you're and then you're ready to go.
Yeah, Dick brings up an excellent point. I would also add to that that you cannot make these types of distributions, qualified charitable distributions, from inherited IRAs. So oftentimes we'll have people that have inherited IRAs that they're making distributions from currently, and it has to be a standard IRA account.
You alluded to the bunching concept here a few minutes ago. Talk about the conversation you might have with someone and why they might consider bunching under this new tax format.
Well,
I guess,
go ahead, John.
Okay, so I guess we're primarily talking about that with people who make more modest gifts in any given year. So a lot of this changed with the tax changes a couple of years back when the standard deductions essentially doubled. So if you have someone that gives, let's just say $10,000 a year, it's a couple, give $10,000 a year, some of the deductions they had before from property taxes and state income taxes, that's capped at $10,000. So if they don't have any other deductions from healthcare expenses and their charitable gifts total $10,000, they're no longer getting any credit for that, and they're probably taking the standard deduction. So what we talk to people about is they just think about what your giving plans are for the next 5 years, let's say. And if they're giving $10,000 a year, they could take $50,000 if they have the sufficient resources to do so, and make all those gifts in 1 year. And if they can do that in a year when they have higher income, particularly if it's someone who's approaching retirement, maybe the last year or two of their retirement, better to set that money aside as they're getting ready to retire before their income drops, get as much credit as they can in 1 year. Sometimes people will fulfill their charitable gifts to Houghton College or their church or other charities all at one time. Sometimes we see people put money into a donor advised fund all at one time and then have a plan to give that money out over the coming years so they can still give the same amount, $10,000 a year, but get that $50,000 deduction all in 1 year. So that's what we refer to as bunching or bundling of those contributions.
Yeah, I think the other thing that I like about donor advised funds is, if I'm looking 2, 3, 4 years down the road, I may not know exactly where I'd like to make charitable gifts 3 years from now. I may have some charities on my list that I know I'm going to support year after year after year, but there may be other ones that I don't know about right now. If I put the money in a donor advised fund, I'm not committing myself to making a gift to any particular charity. The money's there if I want to do it, but I can add or subtract charities as I go. And it's easy to do. You log into your account, you pick out the charity. They confirm that it is indeed a tax deductible charity that you want to give to, and then they send a check.
Dick,
and I would add one thing to that, if I may. I think that the concept that Dick described is especially powerful for people who are not yet of required minimum distribution age. And if you're younger than that, you're giving money to a donor advised fund that's not in an IRA, that's not in a 401k typically, and you have the ability to actually contribute appreciated securities. So in this strong stock market climate, if you have stock from Amazon or many of these companies that have done very, very well, you can actually give $100,000 of stock that you paid $10,000 for and get a $100,000 write-off, put it into that donor advised fund. They'll sell it for you, diversify it, no tax consequence, and you have that money diversified that you can then give out over the coming years.
So this is a good transition point. We are living with an unprecedented, growth in the stock market, and there are many, many people now that have accumulated assets and appreciated stocks. And this is a wonderful opportunity for them to make maybe the largest gift that they've ever made. And why is this the right time to consider gifting appreciated assets? And then contrast that with if they didn't do that. What are the ramifications if they were to, make an outright cash gift after selling the appreciated securities, and what are the advantages there?
Dick, do you want to grab that one?
Sure, I can begin that. I've done examples like this for classes that I've taught when we've discussed this. I've done examples for tax clients that I've had over the years. And if you think about it this way, let's say you want to make a gift of $30,000. If you take that out of ordinary income, as we've just been discussing, I've got to get past that standard deduction limit before I get any benefit from it. That's still going to be true if I give appreciated securities. On the other hand, if I sell an appreciated security, I've got to pay capital gains tax on that, or if it's a short-term gain, I have to pay tax at an ordinary income level. I can avoid all of that. I can get the benefit of all the gains. So maybe I have that. I make that $30,000 gift with stock that only cost me $5,000 or $10,000. I get the full benefit of that $30,000 gift, which will again kick me above that, for sure kick me above that standard deduction limit, and I pay less tax to the government, and the charity ends up with more money than I would otherwise be able to get.
Yeah, just a couple points to add to that. If you're giving appreciated securities, it has to be held for a long-term gain. So you want to make sure that you've held it for at least 12 months and 1 day. You don't want to give away securities that are at a loss. You'd be better off just selling those, taking the loss yourself, and giving cash. But a lot of times we find people that they'll give stocks to their children, they'll give cash to charities, and we tell people it should be the reverse. You give stocks to your children, you're giving them the cost basis. You give it to the charity, you get the full tax deduction, and the charity can sell it free of tax. So it's really the whole idea is to pass as much on to charity as little on to the government at the same time.
Yeah, that's a great point. We have, just like increasing number of donors utilizing gifts from their IRAs, we've also obviously seen increased number of donors utilizing appreciated securities. So the message is getting out there. It is being received. Speaking of beneficiaries, so I think one good point is an IRA a good, is it good to leave your IRA to your descendants versus a charitable organization? What are the advantages or disadvantages there? Any retirement account.
If you have a portion of your IRA that you want to leave to a charity, you segment that out and name that charity as a beneficiary, that money will go tax-free. We generally don't advise people to name their children and a charity altogether in the IRA at the same time. But if there is a portion or all of the IRA that you want to go to a charity, separate that out and name the charity, and that will go tax-free. And that's typically a better way to pass money to charities than leaving leaving money through a will that has already been taxed.
Yep. Yep.
It's something we discussed in the office today too, in terms of if you're looking at leaving money in your estate to your children as well as to a charity. We were talking about if you had appreciated stock and you have your IRA, which is better to leave to the charity and which is better to leave to the children. And I think I got the answer, but I'm curious to see what your advice would be in that situation.
We advise people to favor leaving standard IRAs to charities rather than appreciated securities. If it's a Roth IRA, that money's free of tax. We would leave that to the children.
Yeah, because I think what we talked about is we didn't necessarily settle this, so you could basically settle this this disagreement now, and I'll get back to this person tomorrow and hopefully gloat. But no, we were talking about whether or not, if, let's say I buy a stock 20 years ago, and if I sell it now, it's based on the price that I bought it at in terms of capital gains and everything else. If I leave that stock to my children, if they were to sell it, do they pay taxes based on the original cost basis, or does that reset when it's left to them in the estate?
Under current law, there's a step up in cost basis if they pass it through the estate through death.
So they wouldn't have the capital gain, at least if it had appreciated over all those years, they wouldn't have the as much capital gains to pay as if I sold it before I were to die and had to pay all those. Okay, good.
Yeah. That's all. That is a topic that is always up for discussion by politicians, however, and some of them see that as something that they can go after because they don't feel like that really hurts anybody. They seem to think that only rich people own stocks.
Yeah, so I want to remind everyone, if you have a question, please unmute yourself and feel free to ask it at any point. You can also put it in the chat where everyone can see your question, or you can send the question to me or to Dan individually. And we're about to, I want to be able to take some individual questions, but I'll lob one more out there. Speaking of a little bit of politicians, okay? We've just come through a very interesting season. And so this may be the toughest question for you to answer, and so tread lightly. But what effect do you think that the presidential election will have on the stock market and ultimately charitable giving moving forward here?
Well, I think that the stock market didn't dislike the result. I mean, we don't know exactly how everything will play out. We have some Senate races coming up. But I think the one thing that's pretty clear is our country's still very divided. Politically, we're very divided. The House and the Senate are very close. And, the takeaway that we take from it is it's going to be difficult to see major changes without some form of compromise. So that's a recipe for gridlock. And, it's not necessarily a bad thing for markets. And with regards to charitable giving, Dick made the comment earlier that stock market's, at a high even despite the pandemic. So I guess what we're telling people right now is, from a giving standpoint, particularly if you're giving stocks and securities that have appreciated, it's as good a time as it's ever going to be. And one thing this year has taught all of us is that it's exceedingly difficult to predict what's going to happen to the stock market, at least in the short term. So, take it for what it is. I have no clue where things are going to be a few months from now, but it's pretty good right now, and take advantage of it.
Yeah, I guess I'd add, usually the market doesn't like uncertainty. So when the path forward looks at least somewhat optimistic in terms of, okay, we know what's happening, the market figures out a way to deal with that. And we've had two positive things happen in the last week. The election, at least for the most part, has been concluded, and we got an announcement that at least one vaccine for COVID-19 seems to be promising, and so the market's going to like that. Now, what happens under a new administration and the tax consequences and related to that remain to be seen. So I concur with Jonathan that with the tremendous increase in the stock market, now's an excellent time to move ahead with a giving plan if somebody's thinking about that.
All right. The floor is completely wide open. I would love for someone else to ask another question, related question, ask for clarification, or anything else that you would like to share.
I have a question. You said that you can deduct up to 100% of your income. Does that apply also to appreciated stocks, or isn't there a lower limit for appreciated?
Yeah, there is a lower limit for appreciated stocks. So my understanding is that it's 30%, but you can carry that forward over a period of 5 years as well if you can't use it all this year. And it's probably worth pointing out that you can give a combination of appreciated stock and cash to get to that 100%. So you could give 30% appreciated stock and 70% cash.
Yeah, 30% of AGI for contributions of non-cash assets held more than 1 year, and 50% of AGI for blended contributions of cash and non-cash assets is correct. Yeah.
So the recent regulation didn't increase that amount.
No, I don't think so. I think the only increase was the 60 to the 100% for the AGI deduction limit for cash deductions. Is that correct, gentlemen?
Yeah, I believe that's right, Carl.
Okay.
I attended a tax conference today, and the section on estate planning said that one of the things that he would like to do is to eliminate the step up in basis when something passes through an estate. So if that happens going forward, it could make a difference of whether you want to leave appreciated securities and other assets to your children.
That's one of those gray areas. You know, there's also discussion about dropping the estate tax limit down to 7 million per couple. You know, we're not quite sure how that would work with doing away with the step up in basis. So I think, you know, I think that it's one of those things where the law can always change.
Let me throw one other thing out there that hasn't been discussed, and this relates to and may be relevant to some of the kinds of people that I have advised over the years. You know, as you're moving into retirement, it's sometimes unclear. Well, how much money am I going to need? And that can sometimes make people pretty cautious in giving away a huge chunk of assets, because you say, well, yeah, but what if I need it? You know, I can't get it back after I've given it. And so for folks who want to see a charity benefit, and I've done this with several clients when I've looked at their will and realized that they have a designated amount of their estate that they want to go to a charity. I say, you know, maybe you ought to consider the joy of giving this while you're alive. And yes, I realize you need income, so why not consider a gift annuity or a pooled income fund where you can continue to receive income as long as you're alive, or as long as you and your wife are alive, you and your spouse, and then the charity gets the remainder. And sometimes that's just the kind of reassurance that somebody needs to say, yeah, this is something that I'd really like to move ahead with. And again, they get the joy of making the gift while they're alive rather than waiting until they're dead.
Yeah, so Dick brings up a good point. We call those life income gifts. Charitable gift annuities are a very popular life income gift through Houghton College. The minimum amount for Houghton is $25,000. We also, one of the other things that we offer and manage our charitable remainder trust, charitable remainder unit trust, CRUTS. The minimum amount for that is $150,000. And both of those are offering either, you know, a fixed amount of dollars for the rest of your life or a fixed percent of return for the rest of your life. And those are wonderful planned gifts through Houghton College that are available.
Those do offer tax benefits. It's a little more complicated in terms of how much of a tax benefit you get for setting up the initial account, and then how much you get on a year-by-year basis. But that's something that we could provide anyone with in terms of an illustration that shows what the taxable income is for the first, second, third, fourth year that you're in, those kind of, whether it's an annuity or whether it's a trust. So, and we've
it's usually based on life expectancy. So the older you are, the greater
Yes.
the tax benefit.
Yeah. There are some advantages to aging in this case. Yeah. So one of the things that we have a privilege of doing is hearing the hearts and the passions of alumni and donors who want to give through Houghton to accomplish their goals. And, I kind of want to tie some things together. We talk about the stock market where it is, we talk about accumulated assets, and the ability for people to enjoy, receive joy in their lifetime from their giving. And we saw an overwhelming response to the concept of endowment during the course of the campaign, and particularly the creation of endowed scholarships. Someone alluded, one of you alluded to donor advised funds. And one of the things that allows you to do is to plan year after year and potentially funding, an endowed scholarship over a series of years. Others gave appreciated stock one time to create their endowed scholarships. Our two experts tonight, what I love about them, it isn't just the fact that they have this head knowledge, it's also the heart knowledge. And they too, chose to create endowed scholarships through Houghton College over the course of this campaign. And I didn't tell you I was going to put you on the spot, but I want to put you on the spot a little bit. I would love for you to kind of talk about, what was your heart, what motivated you to create that? And then how did you make it happen as you thought about utilizing the assets and the resources that God entrusted to you?
Well, Houghton College was a wonderful 4 years. So that helped motivate me, Carl, when you made that suggestion, and just the idea of helping people, particularly people that may not have the resources to attend Houghton College without that type of assistance. That's a rewarding thing. So, looking forward to hearing those stories about people who are able to benefit from the scholarship over the years.
Well, in our case, we simply accelerated something that we intended to do through our will. And again, it goes back to the desire to do something while you're alive, rather than wait until you pass. When there's no satisfaction in seeing the whole thing set up and initiated. And in our case, we can do it through qualified charitable distributions, and take money that annual income that maybe we don't need at the time, and carry out our long-term goal, and see immediate benefit going to students.
Yeah. So George, and I don't know if Diane is on the line with you. I see that you're unmuted. I know one of the joys that I've had in my discussions with you is that you have forged personal relationships with the students who have received the Bagley Scholarship. What does that mean to you? And I know it's hugely meaningful to the students.
Can you hear me?
Absolutely.
Well, for us, Diane has always been interested in providing something to the next generation in a personal way. And so we've had 3 separate young ladies who've had had some of the scholarship money. And so she has maintained some contact with them through telephone calls or internet. And then we pray for each of them every night in our devotional
Love that.
time.
Yeah.
And let them know that. So it's been a real joy for us to do that.
Even after they graduate.
Yeah, we still keep in touch with Brianna, even though she's out now and working.
Yeah.
So it's a real joy to do that. So we appreciate what we get back from the college, a name and a picture and a little note. And it's such a joy to us to do that.
Yeah. And I look forward to some of you others here have, recently created endowed scholarships, and I can't wait for you to get to know the recipients and the impact that you're having on their lives moving forward as well. So again, I'll throw it open. Any questions that you might have, and as you think of those last minute questions, I mentioned that this is the inaugural Ask the Experts format. What other topics might be of interest to you moving forward? And is there an what would be your appetite? What would you recommend? Let Dan or I or anyone else. So Ben Coulter is on the line. Skip Lord is on the line. Please touch base with any of us if you have questions or ideas. And, Dick and Jonathan, I know, said to us, hey, we're available too as a resource. Feel free to reach out to them. And, there are no dumb questions. So last chance for questions along the way, or anything else someone has to offer. Larry, I see your hand up.
I'll ask a question for either Dick or Jonathan. Any predictions on how likely the Biden administration is going to reduce the estate tax threshold? Jonathan, you mentioned it's 7 million per couple or 3.5 million per individual. Is that likely going to happen, or are you willing to even hazard a guess?
Well, it'd be a guess, but I guess what I said earlier is it looks like the election is very close. So to me, that reduces the likelihood, at least in the next 2 years, of major changes. Over the longer term, it strikes me no matter who's president, taxes are going to have to go up. I can't see them. I mean, there's no they're ever going to be. So taxes almost have to go up over the longer term. But in the next 2 years, it does not seem likely there's going to be major change. That's about all I could say on it, I guess.
Yeah, I'd agree with John. I would agree with Jonathan on that. And beyond that, I would hazard a guess. I know what I'd like it, I'd like to see no changes, but again, as Jonathan suggested, we're giving away a lot of stuff this year, and that's as everybody anybody that's ever had an econ course knows the phrase, there ain't no free lunch.
Mm-hmm.
Tim, you had a question?
I do. Tell me more about the donor advised fund. That's new to me. I mean, establishing it, who maintains it, all this kind of stuff. Is there a thumbnail sketch?
Well, I can talk about the organizations that I have investigated and worked with, either on my own or with clients. And I mean, these are just 3 examples. Fidelity, Vanguard, and TIAA all have donor advised funds. You fill out an application, set it up, you decide how you want to fund it. They typically have minimums. I think the minimums that I'm familiar with start as low as $5,000. Although some organizations have higher minimums. There's also, with every organization, some kind of account management fee. And so you need to make sure that you're putting enough money in to so to keep the management fee a small percentage of the total. So again, I can speak only to those 3 organizations that work well for funds. I'm sure Jonathan and Jonathan's company may have an option of their own as well.
I think one of you said yesterday, when there's an unexpected windfall, an inheritance, a bonus, or something like that, that might be an opportune moment to consider a donor advised fund. Would either of you like to speak to that?
can talk about that a little bit, and that just has to do with managing the tax consequences. So if you have a windfall, some sort of taxable income, and it's going to push you into a higher tax bracket, sometimes what we'll do with clients is, look at, if charitable giving is one of their goals and something's important to them, we'll talk to them about this might be a good year to accelerate that a little bit. If you're in a higher tax bracket and you give a bunch of money in that particular year, under current law, you're getting a much bigger credit for that, much bigger break, if you will. So bundling those gifts together in a year in which you have a lot of income is an efficient way to do that. And then you can give the money away gradually over time, including in years when your income would be lower and you would not have gotten as much of a tax benefit for that gift.
Yeah, I think the key to what Jonathan said there is you'd really prefer to see taxable income go into a donor advised fund, so you get a tax benefit. So something that comes to you tax free, I wouldn't put that in a donor advised fund. Either current income or appreciated securities, as we've discussed. The other thing that I might mention about donor advised funds is that you can typically select, while the money sits there, it can continue to grow based on how you want to have the money invested. So you can invest the money very conservatively. You can invest the money more aggressively.
Okay. Thank you.
We do have quite a few donors who give to Houghton through donor advised funds and find that that's the way that makes the most sense for them in their particular situations. And so that's something that we can help make sure with whatever organization you use that the money does come to the college. And sometimes you have to let us know that the payment's on the way, because sometimes the payment just says Fidelity or Vanguard. And so we have to backtrack and figure out who it came from, because the taxable event is when you contribute to the donor advised fund, not when you contribute, and not when it contributes to Houghton. So we have to make sure we know who to thank.
Yeah. Well, I just want to say thank you so much, both Jonathan and Dick, for offering your wisdom and experience and expertise with this group. Whenever I have an opportunity to say thank you to, I see so many really faithful donors to Houghton College here as a part of this conversation. We cannot express our gratitude enough for what you are enabling us to do. One of the things that I continue to tell people as we come out of Impact and as we've grown our endowment, and particularly our endowed student scholarship funds, that positioned us for this most recent pricing reset. The ability to be the lowest priced Christian college now in the nation, the ability for families to obviously know that Houghton College is accessible and affordable is hugely important. And to know that, that's the starting point, and that the scholarships that are awarded from the Student Scholarship Fund, from endowed scholarships, are taken away from that tuition number is very rewarding. And know now that, incrementally, your gift is having that much more of an impact on a family's, decision to attend and their ability to afford a Houghton College education. So, we are just exceedingly grateful. So again, if you have questions, don't hesitate to contact anyone in advancement. Jonathan and Dick are available, and if you can't find them on the internet, we can connect you with them as well. We're grateful. We look forward to it. We trust that you have a wonderful Thanksgiving and Christmas season. And if you have any questions about making a year-end gift to Houghton College, please let us know, and we would love to help you. Dan, anything that you would like to add in closing?
No, I just add, again, appreciate you all being here. It is really a blessing to spend, for folks like Carl and I and Ben and Skip, to spend so much of our time traveling around, hopefully soon again, and just meeting with generous people. When I tell people what I do for Houghton, it's like, yeah, I spend my time going around visiting with people who know what it's like, know the joy of giving and they choose to give it to Houghton, and it's really a blessing. And I know so many of you on this call are part of that, and it's going through a difficult time like now means it means so much to have faithful supporters like we have on this call. So thank you, and thanks again to our experts tonight too, who were so willing to, after work hours, to come in and talk more about what they talk about all day, and they were both enthusiastic about it. So just really grateful for Dick and Jonathan and their willingness to be here.
All right. Thank you, everyone. Good night and blessings on you.
Thank you.
Thanks for the
Thank you,
information.
Carol.
everybody.
Thank you,
Thanks.
everyone.